Welcome to the stage, IGP Faculty Policy Director, Secretary Jacob Liu.
Good afternoon and welcome everyone. I'm Jack Liu, the Faculty Policy Director here at the Institute of Global Politics and a professor at SIPA. And as most of you know, I previously spent many years in public service, including as Secretary of the Treasury, Director of our Office of Management and Budget, and as White House Chief of Staff. The microphone was set for a lower altitude, I think. Central bank independence is a cornerstone of modern economic policymaking. And during my years in government, protecting central bank independence was an article of faith to protecting our ability to manage through economic cycles. The challenges change, but also recur. During the 1970s, insulating monetary policy from short-term political pressures became essential to restoring credibility and stability. In recent years, central banks have been on the front lines to stabilize economies rocked by financial crisis and pandemic. And for decades, that framework served many advanced industrial economies well. But today, the challenges facing central banks are more complex and in many ways more demanding. Policymakers and bankers are navigating a world of rapid technological change and persistent shocks. From COVID only a few years ago to the present-day closure of the Strait of Hormuz, disrupting supply chains and increasing the risk of financial volatility. At the same time, central banks are being asked not only to maintain price stability, but also to safeguard financial stability and, in the U.S., full employment. These objectives often require different tools, different time horizons, and at times, difficult trade-offs. These tensions raise important questions. Is the traditional model of central bank independence still fit for purpose? How should central bankers balance their mandates in a world where risks are more interconnected and less predictable? And how can policymakers preserve credibility and public trust while adapting to these evolving demands? We're very fortunate to have with us today one of the world's most distinguished leaders in this space to help us think through these issues. Andrew Bailey is the governor of the Bank of England and has been at the center of these debates for quite some time, leading one of the world's most important central banks through a period of extraordinary economic uncertainty. He has brought a thoughtful and pragmatic perspective to the question of how central banks can adapt while remaining anchored in their core mission. I had the pleasure of working with Andrew when our teams at Treasury and the Fed worked so closely with the Bank of England in the difficult years following the great financial crisis. He will be joined in a conversation by our own Alan Taylor, who is a professor here at SIPA and also serves as an external member of the Bank of England's Monetary Policy Committee. Alan's scholarship and experience in monetary policy make him uniquely well-positioned to guide this discussion, and we so appreciate his helping arrange for today's discussion. Before inviting our guests up to the stage, let me close by just noting that this is exactly the kind of conversation we aim to foster at IGP, bringing together policymakers to grapple with the most pressing economic and geopolitical challenges, and to do so in a nonpartisan forum. Now, a message for our students joining us today. I also want to encourage you to apply for our IGP Student Scholar Program. The IGP Student Scholars Program helps prepare Columbia students to understand and find solutions to today's global challenges. Students are selected for the program, and they benefit from the mentorship of our distinguished fellows and leading practitioners and scholars. They gain hands-on experience in policy-related research and analysis and engage in dialogue with leaders and experts regarding the world's toughest problems. And with that, thank you all for being here, and please join me in welcoming Governor Bailey to the stage for some opening remarks.
I'm just going to get the water if you don't mind. Well, it's a great pleasure and privilege to be here. It's incredibly kind of you, Jack, to make that introduction. I was just going to add one thing to the introduction, just to illustrate the point that Jack was making about the way in which the challenges move on so quickly that it would be reasonable to think that the events in the Gulf are the most recent challenge to us in this world. Until, I think it was last Friday, I can't remember, you wake up to find that Anthropic may have found a way to crack the whole cyber risk world open. And you think, what did I do wrong in a past life? I mean, this is the challenge. But look, thank you for inviting me to speak today. As Jack said, I'm going to reflect on central bank independence. And I'm going to take a particular sort of cut into it. I mean, there are many cuts you can take into it. And the cut I'm going to take into it is really to set out how I think the concept is incomplete and where it's most challenged. I'm going to use the term CBI for central bank independence from now onwards just to sort of keep things flowing reasonably well. But there will be a strong monetary policy element to what I'm saying because you can't view the two sides of central banking, monetary policy and financial stability apart in this respect. So as Jack suggested, modern central bank independence, modern CBI emerged really out of the high inflation era of the 1970s. Now, it didn't originate then, and it has a much longer history than that. But in its modern form, you can really say that the 1970s was the experience that prompted quite a lot of change. And let me use the Bank of England very briefly to illustrate some of the antecedents of that. And I'm going to start by going back to 1802. It was Henry Thornton, who was associated with the Bank of England, wrote a work called An Inquiry into the Nature and Effects of the Paper Credit of Great Britain. Thornton is sometimes described as the father of the modern central bank. And just a few brief quotes from that work. He said, "The Bank of England is quite independent of the executive government. Reconciling this with the extensive lending of the Bank of England to the government," so no QE in those days at all, he commented that the ground on which the bank lends so much to government is clearly that of mutual convenience as well as long habit. He also said, "The preference is no symptom of a want of independence of its directors. The government of Great Britain is under little or no temptation either to dictate to the Bank of England or to lean upon it in any way which is inconvenient or dangerous to the bank itself. And finally, to suffer either the solicitation of merchants or the wishes of government to determine the measure of the bank issue," think about that as the money supply, "is unquestionably to adopt a very false principle of conduct." That seems quite definitive, really, but let me draw 2 points out from that. What he was illustrating is an older notion of independence, which relied on what in modern terms we would call an alignment of interests and incentives between government, private interests, and the central bank. It didn't have within it anything more formal in terms of independence. That's the first point. The second point is, though, that it did require an anchor, and that anchor was the value of money. And again, this is the last point of ancient history I'll use, but let me go back to John Locke, writing in the 17th century in Britain. And he emphasized the importance of, quotes, money being constantly the same, and by its interest giving the same sort of product through the whole country. Money is the measure of commerce and the rate of everything, and therefore ought to be kept as steady and invariable as may be. Now, taking all that experience on board, throughout the 20th century, and particularly after the 1970s, the idea of CBI being assured only by a balance of interests and incentives looked pretty much past its time. But the anchoring on the value of money was as important as ever. So I think 3 things followed from that. First, for many countries, the UK included, CBI evolved to a system of formal statutory powers established in legislation. Now, I recognise, of course, that there are countries that got there sooner, much earlier in the 20th century, including, of course, the US. Second, CBI remained anchored on the stability of the real value of money achieved through monetary policy. Third, there are differences between countries in terms of whether monetary policy independence relates to setting the objective, the target, or operating to achieve the two of them. Broadly speaking, few independent central banks set their own objectives. On the other hand, all are responsible operationally speaking. The picture is, though, mixed when it comes to setting the target. The UK system is more to the operational end of the distribution, in that we at the Bank of England don't set the objective or the target, but we have operational independence to meet them. But de facto, and in some cases, as in our case in legislation, modern central banks typically have two objectives: monetary and financial stability. The substance of what I'm going to talk about today is around how these two fit together in theory and practice. Now, given what happened in the 1970s, it's no surprise that modern CBI was based around monetary policy. And a core element of the case for CBI in respect of monetary policy is the so-called time consistency argument. Ex ante, a government wants low inflation and stable growth. But during the policy process and ex post, it may be tempted to create a little extra inflation to reduce unemployment or ease debt burdens. But if people expect this to happen, there is no lasting benefit in terms of lower unemployment, but there is higher inflation, so you get the worst of both worlds. So delegating monetary policy to an independent central bank is a commitment device to reduce the incentive to renege on the promise of low inflation. And it could thereby anchor inflation expectations, what people think inflation will be in the future. So, to take the UK case, an inflation target set by the government combined with operational central bank independence to meet that target is designed to ensure that the central bank's incentives are aligned with public interest in price stability. Now, in principle at least, the argument for financial stability works in the same way. Governments want a stable financial system, but can be tempted to lower standards to increase lending and growth. So delegation, put like that, delegation to an independent central bank makes sense. Where I think financial stability differs from monetary policy is that the act of delegation is a less robust contract, reflecting the completeness of the remit and the measurability of the objective, and also because of the different direct impact of financial stability on the long-run growth of the economy, a point I'll come back to. This opens financial stability up to differences in the way conflicts of interest can arise. Financial stability policies interact with private interests in a variety of ways. So a difference is between monetary policy operating through an aggregate tool and financial stability through many levers directly affecting private interests in many ways. Seen in isolation, each of these individual levers may not be essential for the financial stability objective, but they are essential when taken as a set. For financial stability, there is more scope for conflict between the public good interest and private interests. This can put governments in the position of having to choose which side to take. To use Thornton's words, between the salutations of merchants and the central bank. The current debate on levels of bank capital and the Basel standard is a good illustration of this. So it is striking that the literature has given little attention to the concept of CBI in respect of financial stability. In practice, the issue goes further, I would argue, and two features of the commentary stand out for me. The first is a tendency to describe other activities of central banks as tangential to monetary policy, and this set would include financial stability. The second feature goes rather further and suggests that an objective of financial stability can require the central bank to compromise on the objective of monetary stability, particularly when the financial system appears to be under threat of instability. So in other words, we move on from the tangential towards an actual conflict of interest. So what then are the consequences of the system we have today? Well, let me pick out two. The first consequence is that to the extent there is tension between the objectives of monetary and financial stability, it can be pro-cyclical. In other words, the relative priority given to financial stability can depend on the conditions at the time. The period before the global financial crisis saw a relative neglect of financial stability, I would argue. The crisis necessarily led to a surge of interest in and emphasis on financial stability. But this sort of pro-cyclicality is not, I would argue, the best form of organisation. We really need it to be more steady over time in terms of the intensity of focus. And this in itself is an argument for robust central bank independence for financial stability. The second consequence is that the nature and definition of CBI differs between monetary and financial stability. This is very important, and I would argue, and perhaps surprisingly so, an under-discussed issue. Because the two notions of CBI in the context of monetary and financial stability do differ in important ways. Why is this the case? Monetary stability is easier to define and certainly easier to capture in a single numerical target. In the case of the UK system, it's an inflation target. Now, this does not inevitably make the task at hand easier for monetary policy, but it certainly creates a focus. I think it also means that the structure, system, and governance of monetary policy is more straightforward to capture in legislation, though again, not in a way that removes the judgment, the need for judgment to be exercised by the policymaker. So what is it about financial stability that makes it less straightforward? Well, I think a number of elements are relevant here. First of all, financial stability is a large canvas, and there are many elements to it. This means that not only is it impossible to capture in a single numerical target, but it is defined as the absence of something that operates dynamically and across many dimensions, and thereby engaging many private interests. It's also the case that determining the line between acceptable risk and the potential for instability is difficult to ground. Success, in the word of financial stability, comes when nothing happens. Second, it's important to consider how monetary and financial stability affect the real side of economies. The canonical view of the impact of monetary policy on the long-run growth of economies is that, if anything, it does so only indirectly by preserving price stability and thereby reducing uncertainty so that businesses and households can better plan for the future. An older argument with respect to monetary policy is based on the so-called neutrality of money, such that long-run changes in the monetary supply affect only nominal variables, prices, wages, exchange rates. They don't affect real variables, real GDP, employment, investment, consumption. This idea really goes back to the classical economists who drew the distinction between the real and nominal spheres of the economy and treated money as a veil over an underlying barter system of exchange. It followed that the monetary policy was assumed not to affect the long-run trend growth rate of economies. Well, this view has been modified a lot in more recent times. While holding to the view that there is no long-run trade-off between inflation and output, in the short run, modern economists tend to treat money as non-neutral because sticky prices and wages means that changes in money and monetary policy can have a temporary effect on output and employment. And added to this, there is now considerable support for the credit channel effect of monetary policy, working through the supply and cost of credit, not just risk-free interest rates. Financial stability, though, has a more immediate and direct effect on the level and growth of real output, employment, and investment. A stable banking system directly supports economic growth, while an unstable one will tend to disrupt lending and have negative consequences for growth. In this sense, there is no long-run trade-off between financial stability and growth either. Now, this distinction between monetary and financial stability matters in at least two other important respects when we think about central bank independence. First, it follows from the point on growth that financial stability will have clearer distributional effects within the economy and society broadly. This point is important when thinking about CBI, and it can be uncomfortable for central banks because we generally don't wish to be involved in distributional issues. Second, and closely linked to the distributional point, financial stability will interact with many more areas of public policy. Many other parts of government will state an interest as a consequence because they will consider themselves to be directly affected by the outcomes of decisions taken by central banks in respect to financial stability. In my experience, there are many examples of this mechanism at work. And if I go back to the point I mentioned at the start about Anthropic, you see just this point at work. That is a whole different area of public policy, but we can't ignore it. The same goes for private interests. They are more directly engaged by issues of financial stability. Now, this might seem like a very strange thing for me to say because surely people have views on interest rates, and of course they do. But in keeping with the more background property of monetary policy, and critical though that is, the private interests are not as sharply defined typically, and certainly in my experience. So again, the consequence of this difference is that financial stability in its broader sense tends to induce a lot more direct lobbying by affected private interests. It's therefore much more talked about in a specific sense, whereas monetary policy is very widely talked about in a more general sense. And it means that more interest groups feel that they should have a direct say in financial stability decisions. Moreover, I would draw a further distinction within financial stability between macroprudential and microprudential, in other words, system-wide and firm-specific regulation. The issue is much more acute for micro regulation. Because if the activity involves directly regulating individual firms, and the objective of that regulation is to get firms to do or not do things that had not occurred to them based on their private interest, it's pretty easy to see that the challenge to independence will be more direct and more forceful. And in my experience, that's exactly what we see. Another element relates to an important difference in the process of conducting financial stability policy, again, compared to monetary policy. Financial stability policy making often involves setting rules, something which does not arise in the same way for monetary policy, where the term rules has a different meaning. But this rule-setting process can place financial stability work more closely adjacent to the work of governments and parliaments because as financial stability-focused rules change, it will sometimes be necessary for aspects of legislation to change at the same time. Now, my point here is this doesn't have to be inevitably problematic, but it creates two phenomena, I would argue. The first is that the rule-making process drives a regular need for intensive and detailed coordination between central banks' financial stability work and government policy making. The second is that where the boundary is drawn between central bank financial stability rulemaking and what is done by governments and parliaments varies widely across jurisdictions and through time. So the conclusion here is that the meaning and substance of CBI is different between monetary policy and financial stability. And it does interest me, this point is not often made quite so directly. What are the consequences then of this distinction? I can think of times when there has been pressure to avoid compromising monetary policy by placing emphasis on the financial stability sibling. It can also cause approaches towards financial stability to be pro-cyclical, in the sense of only wanting or having to deal with it when times are difficult. There is also a noticeable pro-cyclical nature to the private interests and the lobbying. Thus, as episodes of financial stability recede into the past, the lobbying grows. And this can be challenging because an important part of financial stability policy is counter-cyclical. In other words, use the better times to build up the defences. And I think the best statement of this condition came from the economist Hyman Minsky. So just to quote him, as a previous financial crisis recedes in time, it is quite natural for central bankers, government officials, bankers, businessmen, and even economists to believe that a new era has arrived. Cassandra-like warnings that nothing basic has changed, that there is a financial breaking point that will lead to a deep depression, are naturally ignored in these circumstances. Now, I should say I've used this quote from Minsky before. After I did so on the previous occasion, someone came up to me and said politely, "Don't you think it's time to retire Minsky?" I put that on the record as illustrating perfectly the point that Minsky was talking about. But that leaves the question, what to do about all of this? And more particularly, we're left with a situation where we have two rather different forms of CBI, or at least sufficiently different, I think, to be an issue. In terms of the responses, let me rule out what I call either end of this possible range. I don't think ignoring it is acceptable, nor do I think we can try to override the underlying drivers and make each form the same. So that leaves two options. One is a form of status quo. It is to accept that central banks have two objectives, monetary and financial stability, and there are versions of legislative independence attached to both, which can differ, and then to say, let's limit our ambition to being more transparent in setting out the differences. That would be a step forward. But I'm now going to argue that I think we should be more ambitious. By arguing for ambition, my view is that we should start by identifying what ties the two objectives together rather than what makes them different. Is there a single unifying definition of the objective of central banks which, while not ignoring the difference, seeks to set out the common ground. And in doing so, is it possible to use this common ground to create a more useful and resilient objective? The simple answer to whether there is a single and unifying definition of an objective is yes. And I think it's actually staring us in the face because it actually goes back to John Locke and the value of money. One way I've come to this conclusion is one of the most enjoyable things about being in the Bank of England. I've got two colleagues from the Monetary Policy Committee here. They may or may not agree with me. I think they do, actually. But we go around the country talking to businesses, but we also try to go and visit schools. And I usually talk to economics and business students at our equivalent of high schools. And I give a few minutes introduction on the Bank of England and what we do before taking questions. And over the years of doing this, I've concluded that the best way to start is by saying that at the bank we're in the money business. Usually gets a laugh from the students. Well, sometimes. And then I go on to describe what I mean by it. So what does this mean in terms of an overarching central bank objective, the value of money? In some ways, actually, the easier part is monetary policy because the objective of price stability is the stability of the real value of money. Defining financial stability is the harder piece. But can we anchor financial stability more in the stability of the nominal value of money? I think it has a potential as a definition. The key element of financial stability here is the banking system. Most of the stock of money is on the balance sheet of banks. Fractional reserve banking ties together the money and credit systems. And the key here is the assured value of the stock of bank deposits, the stock of commercial bank money, also known as inside money. And for payments, another of the core functions of central banks, the system also depends on the assured nominal value of this inside money. In other words, we all trust that a dollar or a pound in my account is worth a dollar or pound in your account when we make payments to each other. There is, of course, an important anchor to underpin the assured nominal value, namely the ability to convert inside money into central bank money, outside money. Now, as Milton Friedman and Anna Schwartz documented, this assured value of inside money was not always true in the history of American banking, where there was an absence of outside money and the system was unstable, if you go back to the 19th century. And beyond providing outside money, as a central bank, we regulate banks in good part because we want to ensure trust in money, and that means assured nominal value. To give you an illustration of that, I think that concept of assured nominal value helps to explain why it tends to be very hard in practice not to assure the nominal value of uninsured bank deposits, why that is a recurrent issue every time we have a bank crisis. Coming up to today, another very topical issue of the moment, when I look at an innovation such as stablecoins, my reaction is that if you want to be in the payments business in scale, and payments are a key function of money, you need to meet the test of money and trust in it, which is assured nominal value. Now, that's another talk, so I'm not going to give that today, other than to briefly say that I think for some stablecoins, some more work is needed on this front, and I think more work is needed on the standards. But there is a big question outstanding in my attempt to capture more thoroughly financial stability under the single central bank objective of the stability of the nominal value of money. And that is the financial stability objective only about money? This, to be honest, is a genuinely open question. It may be that nominally stable money is necessary but not sufficient to ensure that the financial system is able consistently to deliver essential financial services to households and businesses. I would argue that definitionally, nevertheless, nominal value stability is a good step forwards. But let me also briefly set out why I don't think the issue is as large as it may seem. Let me start by recognizing an important point. Since the financial crisis, the non-bank financial system has expanded in size relative to the bank system. If you look today at the agenda of the Global Financial Stability Board, which I also chair, you cannot help notice that it has a very large component of non-bank items, indeed larger than the agenda of bank items. Now, on the face of it, that looks like a problem for my argument that central bank financial stability objectives can be captured under the value of money. I'm not sure, however, that's necessarily the case. Yes, the non-bank sector has expanded. It reinforces the separation between banks whose liabilities are money with assured value, and non-banks whose liabilities are investment-type instruments, where the investor should not expect assured value. They take more risk that way, they can earn more and they can lose as well. But it would be a mistake to believe that we've separated the bank and non-bank systems in a rigid way. We haven't. The non-bank system relies on the bank system for liquidity, and in turn, the banks are underpinned by central bank liquidity, outside money. The bank and non-bank systems are highly interconnected, but in somewhat different ways to those before the financial crisis. To give an example, banks support non-bank leverage in financial markets via their prime brokerage activities, which are now of a very big scale. So when central banks look at financial stability in today's world, a lot of our focus is on the interlinkage between the banking and the non-banking financial systems. And some of this interlinkage is on the balance sheet of banks, some of it is off balance sheet but contractual, and some of it is the potential for contagion in spite of the absence of formal contractual connections. Another interesting question here is whether the money anchor of a financial stability definition should factor in more explicitly the velocity of as well as the value of money. Just for illustrative purposes, let's think in terms of the simple traditional quantity theory of money, MV equals PY, where M is money supply, V is the velocity of money, P is the price level, and Y is real output. Now, the typical simplifying assumption in that world is that V and Y are broadly stable, and thus the price level responds to changes in the money supply. But what happens when that's not the case? Let me take the so-called dash for cash at the outset of COVID as a very good illustrative case study of this. Happened in my first week as governor, which allows me for many reasons to say that Mark Carney has brilliant timing and I have terrible timing. There was a precipitous fall in real output as economies shut down. At that time, the rate of inflation was generally very low, and there was a so-called dash for cash. Firms, for instance, drew down credit lines with banks out of fear of access as economies entered such a difficult state. They hoarded money. So M, the money supply, rose, but V, the velocity, went down very sharply. Let's assume for a moment that central banks had not stepped in to provide money via quantitative easing. There was a risk of a major financial stability problem, as the demand for liquidity was not met, and that would have further rebounded onto the state of the economy and onto monetary policy. Now, I'm not, for a moment, I have to get this on the record, I'm afraid, pretending that this provides an answer to whether QE should have been short-term or more prolonged at that time. That's another question not for today. What I do say is that this illustrates how there was a strong money anchor to the financial stability question. A core element of financial stability is that financial institutions which hold money should be trusted, and thus that the value of money can be trusted. Let me illustrate that very briefly with a contemporary issue. There is more concern now, following recent events, about the resilience of so-called private credit. This is a non-bank activity that has grown rapidly since the financial crisis. The point is sometimes made that private credit lending to corporates outside the banking system has grown rapidly because the banks have been over-regulated and therefore are not lending. I think this misses the important point. The main liability of banks is money. We regulate banks to ensure the value of that money. The liability of private credit is not money. It doesn't and shouldn't come with the same assurance of value. That's important to generate lending to support economic activity. That difference is fundamental. The job of financial stability is not to stop any of this, it's to ensure that the distinction is robust. And that is what we have to challenge, test, and design into the system. So I want to leave open the question, can we usefully capture the objectives of central banks' monetary and financial stability under a single description of the value of money? It needs to have its tires kicked. But a key part of financial stability is maintaining the integrity of money. That said, frictions and imperfections in the financial system can lead to suboptimal outcomes in many states of the world, and notably in bad states when amplification mechanisms can kick in. As with any other type of public policy, there is a role for financial stability policy in mitigating the effects of these frictions. Financial frictions can, however, have much broader effects than just via risks of the integrity of money. In theory, at least, that motivates a much broader role for financial stability policy, particularly with a wider focus on continuity of financial service provision. But it is interesting, and I think remains an open question to consider where are the limits of what an independent central bank should do in the financial stability space. It is then even more incumbent on us to explain what we're doing, why, than it has to be necessarily in a more tightly defined monetary policy space. But to finish, I do see merit in creating a single overarching narrative with a strong focus on the value of money. It would, I think, help to remove descriptions of financial stability such as tangential or in conflict. And even more important, it would help to anchor financial stability by emphasizing the importance of the value of money. And this is important because independence in respect to financial stability is otherwise not as robust, and I would argue not robust enough. Thank you.
Okay, thank you, Andrew, and thank you, Jack, for the introductions as well. I'm Alan Taylor. I'm an economist and also a professor here at CEPA, and it's a great honor and a pleasure to welcome Andrew here. And what you may not know is that Andrew's career began as an academic economist, an economic historian, in fact. Yeah. So there's a great deal of affinity here, and your speech alluded to sort of many historical events and influential authors from the past. So let me get your questions ready. I'm going to take them in bunches of 3, and we'll do that in a minute. I just wanted to start off with the prerogative of asking the first question with some reflections.
We should, of course, say that, Alan, you're also a member of the Bank of England Monetary Policy Committee, and you have got the entire economic history components of the Bank of England's Monetary Policy Committee probably here. I think we probably can claim that, can't we? Actually?
We probably can, yeah. Not sure we want to, but we can.
Yeah.
So I want to go back to something said by one of your predecessors, Mervyn King, about what happens during a crisis and how when people use the words, the central bank is the only game in town, that makes him want to get out of town. And that really pertains to the fact that, the central bank controls high-powered money. And in a crisis like a dash for cash, that's what counts. And that's the ultimate defining concept of stable value that you alluded to. So great speech with the symbiosis between inside and outside money, or high-powered money. But it also made me reflect on another one of our predecessors, Paul Tucker's questions about unelected power, about where should you draw the circle around what the central bank does in terms of its independence and its mandates. And I think I'm channeling Paul here in that the clean concept is just monetary policy and the inflation target, and getting too many extraneous objectives can just muddy things up. And sort of the old model of the 1990s was built around the narrow definition, but then we had a comeuppance, a learning experience of the financial crisis, and financial stability has been bolted on. So you really went into the details of why financial stability is more complicated. Many levers, many targets, harder to measure. And so at the end of the day, is it just really sort of an inevitability, though, that you have to bring it in? And I think maybe Paul's view would be to say, well, it's because you're the lender of last resort. You have the high-powered money. If you're going to have the responsibility to do this in a crisis anyway, then you should have the power ex ante to be regulating this. Maybe because you have that power, but also maybe you have the technocratic capacity. So is it the best monitoring as well as the lender of last resort power that really forces us into this position of having to try and figure out what this financial stability piece of the central bank independence and mandate means?
Well, I mean, it's a really good point. I should sort of say that Paul, Mervyn, and I worked together for many years on these issues. So there's a lot of common ground in our views, probably. I mean, the thing that I would draw out from that is, first of all, is the pro-cyclical point I made. I think the financial crisis is the best illustration of this, and Mervyn's comment is the best. When you're in a crisis as a central bank, you just can't avoid it. Because, as you said, to pick up Paul's point, you're the lender of last resort. Ultimately, it comes back to the central bank. And that leads to the view, I think where we are now today is because of the pro-cyclicality, you cannot afford to be what I call out of financial stability at the other in the other times when you're not in the crisis. I don't think that's a sensible policy, sensible place to be, because you are then storing up problems, which you eventually have to come in and deal with. And the cost of dealing with those, as we all saw in the financial crisis, is larger. Yeah. Let's take the contemporary situation. We're obviously going through another large shock in the world economy. That has monetary policy implications. It has potentially financial stability implications as well. And I would argue that we are in a much better place today because we have got a resilient banking system than we would be if we didn't have it. I think if we didn't have a resilient banking system today, I'm not going to predict what would happen, but I think we would be spending a lot more time worrying about financial stability. I'm not saying we're not worrying about financial stability, but we have got a resilient banking system, and that is because we've spent best part of 17 years now since the financial crisis, ensuring that we got back to that position. The final thing is, I always say, does that mean every rule we have is perfect? No, of course it doesn't. But that underlying resilience is important because we don't get stability more broadly and we don't get growth in our economies without it.
Great, thank you. So let me gather some questions, 3 at a time. Ben here at the back and one here at the front. So.
Thanks very much. Oh, is that off? Oh, you have to do that. Okay, thanks. That was great. By the way, for what it's worth, I think we should have done in March 2020 what we then did 2.5 years later during the Truss episode and made it temporary. But that's another debate. I was just going to ask you about, you mentioned private credit, and you suggested that the primary concern should be with the banks whose liabilities are money. If I pushed you right to the extreme end of that view and said, would you be happy having a narrow banking system whose only assets were government liabilities, and that all credit provision should be done by these vehicles, and maybe you have conduct regulation to ensure they're not mis-selling stuff, but beyond that, it's not the business of the central bank. I mean, is that the logical, or at least extreme outcome of the view?
Okay, and we're going to gather some more questions. Is that Sylvia at the back? Yeah. Continuing the Bank of England alumni program here.
Yeah, ex-Bank of England here. I appreciate the effort to bring financial stability back to the value of money, so it's key to central banking, and we're not procyclical in its interest, I'm trying to twist my brain really to understand what you mean deeply about anchoring it into the value of money, because if I think about the GFC, which is the moment of true panic, there was no really doubt about the value of money at the time. There was no question about inflation. If anything, depreciation could have brought in a less value for money, but I can't see the argument about how financial instability is about the value of money. If anything, it's about the doubts about whether the custodians of money are trustworthy, but not the value of money. So I would appreciate some enlightenment on that.
Okay, and one more question at the front here. Yeah.
Hi, Tom Rees from Bloomberg News. You mentioned Anthropic a couple of times. Could you just explain how worried you are about that? Are banks understandably ill-prepared for that? And just very quickly on the monetary policy front, we've got a meeting in a couple of weeks. I think you'd hoped you'd have more clarity by this meeting about the Iran situation. Clearly we don't. Is this another kind of wait-and-see meeting where you kind of sit on your hands?
You mean the next MPC meeting?
Yes, yeah.
Right, yeah.
Andrew,
what do you think, Alan?
I don't know. What do you think?
Right, let's take those in order. Private credit, narrow banking. I don't think narrow banking solves the problem. So let's just be clear. In a narrow banking system, you would essentially have risk-free assets on the backing the deposits. But I think you've then got the question. You've then got to have the credit creation function taking place, obviously entirely in the non-banking system. And what is the connection? I mean, are you then saying, the central bank essentially is entirely, the banking system is entirely going to, the narrow banking system is entirely going to have government debt as its backing asset? Or are you envisaging, some form of connection via the balance sheet of the central bank? I think that's a big step to take to say it would be a more efficient system to go to that complete separation. As I said earlier, I think what we have today is a more resilient banking system. But let's be honest, there are connections. The connections have changed post-financial crisis. But I think narrow banking is a system that creates a very different environment for the credit system, certainly. Sylvia, I'd really disagree with you on this point about value of money. Let me make a distinction between the real value of money and the nominal value of money. I think this is really important because I think financial stability is about the nominal value. Monetary policy is about the real value. You see, I'd put the question back to you, why did we have, if there was no doubt about the value of money, why did we have bank runs? I mean, I think that is really pointing to the fact there was concern about the nominal value of money. I won't name it, it's a bank that failed at the time. So I mean, I had to deal with a lot of these cases in the UK. And one of them I remember that failed, the directors got very annoyed with me and said, our bank had the highest capital ratio in the whole country at this point in time. And I said, well, it's very interesting. Why were the deposits all heading for the exit? Didn't believe you. And also, they will take, even if you did today, they're taking a forward-looking view and they didn't believe you. So I don't agree with you on this point about lack of assurance and nominal value of money. I think that was really, in a sense, the essence of the issue, that there was, the concern about the nominal value of bank deposits reached a point where there was a loss of confidence in the system and people were exiting banks. Anthropic. I mean, to be honest with you, Tom, we're all, keen to work out what this actually means. I don't, was it Tuesday today, isn't it? I think if we've been having this discussion at the beginning of last week, I think we'd have all been saying, sorry, what's this about? So the issue is, to what extent is this new version of their product going to be able to, in a sense, identify vulnerabilities in other systems which can be exploited for cyber attack purposes? We've all got to get to the bottom of this. But I think it's a good illustration of the sheer breadth of financial stability concerns, because I would say if people ask me the question, what risk has come up the league table fastest since the global crisis, I would say cyber. It's also the one that will never, and Anthropic illustrates this actually perfectly, it's the one that never goes away. You have to keep mitigating it, but the threat actors will move on. So we have to deal with it. Now on the MPC, I'm afraid probably, Alan, I think you're going to get sort of obviously studious neutrality from both of us at this point. It's obviously, it's a major supply shock. I said in the paragraph I wrote in the last MPC minutes, there's no question that the best way to deal with supply shocks is at the source of the shock. The source of the shock is not monetary policy. It's obviously what's going on in the Gulf and in the Strait of Hormuz. What we have to do is assess both the so-called first round effects, which is obviously how long is this thing going to go on for, what is going to be the impact of it. But then we also have to assess the second round effects on inflation, which are going to be really, to what extent is it going to generate persistence? And that will require us to set that against the background of the condition of both the UK economy and the world economy we're operating in. And that's the judgment that we're going to have to exercise repeatedly.
And Tom, since I'm just the chair of this meeting, I can't possibly comment. So let's try and take some questions from maybe this side of the room. Siga, and then Jeff, and maybe one more if we have one. Yeah? Okay. And okay, Trish. Okay.
So I worry a little bit about what falls on the nominal money. You talk about deposits going onto that. But I think one thing that happens through both domestic financial cycles and global financial cycles is that a lot of other things heap in there as well. So like run on repo all of a sudden becomes important. So what would fall under your worry about nominal money?
Jeff?
Yeah, I want to not push back, but probe you a little bit more on whether central bank independence is fit for purpose in both monetary and financial stability realms. Monetary policy doesn't raise the distributional issues that you say that it does, but financial policy does. Financial stability does. And so is it right to have actually independent or more independent purpose institution for that, or should it be responsive to political actors who can take into account the variegated distributional effects?
And Trish.
Oh, thank you. So my question is actually really closely related to SIGA's, and it's, where do you draw the line? There's a continuum of money, particularly in this country, but sort of any economy, I think, or financial system that has a very large non-bank, large market-based finance. And the bank to central bank part seems very clear. But what about all of the other near money substitutes, 1 or 2 or 3 or 4 steps away from central bank money? The stability of those things, well, first of all, they're the first things to become unstable, obviously, when you've got a crisis. But considering this, the stability of those would seem to me to be pretty critical from a financial stability standpoint. But I'd be curious to hear, hear your views.
I'll take Singer and Trish together, and then Jeff, if that's okay, come to you, because I think that's probably logical. I mean, I think the run-on repo argument, I mean, I think sort of, as Gary Gorton and others cited out, is extremely powerful, and I would have that inside the money system, because that's clearly, where central banks, I'm afraid, we've demonstrated we have to come in those circumstances. I think, Trish, you put the question very well. There's a continuum. And I think, maybe I should have said this, I would argue that I think we have to be a bit clearer on where the line is drawn within that continuum. So to use some of the examples I did, you see, my view on stable coins is you want to perform a function of money, payments. Therefore, you have to be money. You have to satisfy the condition of money. That's, I think, we shouldn't be against, I'm not against stable coins in principle, not against them in practice, but that's the condition. That's the bar. And I don't think all of them at the moment satisfy that bar. Money funds is always the first thing. Yeah, money funds is obviously another very good example, which we had, again, that's a financial crisis, promising constant net asset value money market funds, and then not actually setting them up to deliver is another very good example. Now, private credit, I would put on the other side of the line and say, look, this is important. We actually want, coming from an economy that has had lower potential growth for some time, we want to encourage investment in the economy. Therefore, we want people to invest in forms that are not money, and where we're not providing any assurance of the value of your investment. And we want to encourage that. So I would say, in a way, we want to, if anything, what I'm arguing for is yes, it's a continuum, but we do need to know where the line is, because if the line is fuzzy, it leads to trouble. I'd say, just to go back to a point I made in my remarks, uninsured bank deposits is a really good case of this. I mean, we have, this is like a trivial pursuit question. I think only 2 banks in the last 50 years have failed in the UK, and we have imposed losses on uninsured depositors. I don't think the US is that different, probably. No, thank you. And that illustrates, I think, that that is an issue that is constantly sitting in there. As you've got deposit insurance, you've set it up with good reason. I think Milton Friedman, a long time ago, argued that it solved the problem, the value for money. I don't actually think it did completely. I think it took us quite a way on the way to solving the problem, but I don't think it completely solved the problem. And I think we still live with that ambiguity and dealing with that issue every time we encounter a bank. Well, thanks, Christine.
And do you want to take Jeff's?
Oh, Jeff, sorry, yeah, sorry. I think, Jeff, your point is very clear. Is it possible to have independence in the same way for financial stability if you start by recognizing, as I sort of tried to set out, that there are more distributional issues, there are more private interests involved, there is a different growth connection? I think the problem is that there is, as I said in my remarks, still the time consistency point. There is still the Minsky point in there. And so, I think there are good reasons why, why there is the case for independence in respect to financial stability. some of us have it more in legislation and others. We have a committee in the Bank of England that is more independent. The US obviously has gone down the FSOC route, which is a committee of the Treasury. But I think the basic case is there, but it is much more difficult to actually, your point is absolutely right, it's much more difficult to establish. And one thing I do think, and it sort of lays behind wanting to sort of make these remarks today, is I think it would help if we actually started by just recognizing that more than we probably do, actually.
Well, I think we're pretty much out of time. I'm getting the warning that we have no more time for questions, but I want to thank everyone for coming out, and particularly thank Andrew for coming to be with us today.
Well, it's my pleasure. Thank you.